Everyone was calling Black Monday. Everyone. War breaks out, futures drop, the fear and greed index collapses to 8, and the entire retail crowd starts writing eulogies for the bull market. Sub 60K Bitcoin, the end of the cycle, pack it up. And then the market opened. What I'm about to show you is not just about what happened this week. It is about a pattern that plays out every single time geopolitical fear grips this market, and the specific structural signals that told anyone paying attention exactly what was about to happen before the market opened on Monday. Because while retail was spiraling into Black Monday panic, the structure was quietly telling a completely different story. And if you understand how to read that structure, you will never be caught on the wrong side of one of these events again. Let me show you exactly what the structure was saying. Welcome back to the Calm Analyst, where we don't react to headlines, we read structure. Not hype, not panic, not whatever narrative is trending on social media at 2 a.m. on a Sunday. Today we break down exactly why the bear case fell apart this week, what the macro signals were actually telling us, and what this means for XRP and Bitcoin going forward. Let's get into it. Let's start with the hard truth about how most retail investors process geopolitical events. Because what happened this week is a textbook case of the crowd getting the analysis exactly backwards. Here's the mechanism that most people do not understand. When a major geopolitical event hits, war, sanctions, a major lawsuit, a regulatory announcement, retail investors ask one question: is this bad news? And if the answer is yes, they sell. They panic. They doom post. They start calculating how far the market is going to fall. That is a surface-level reaction, and it is almost always wrong at the precise moment it feels most justified. What sophisticated market participants ask is a completely different question. They don't ask, is this bad news? They ask, how much of this was already priced in? How strong is the underlying structure? And what is the actual mechanism by which this event affects liquidity flows? Those are three completely different questions, and they produce a completely different conclusion. Here is what the structure was actually saying going into Monday's open. Futures dropped roughly 1%. Not 5%, not 10%, 1%. On a weekend where a war broke out, where Jane Street, one of the largest market makers in crypto, got sued and was temporarily removed as a major seller, and where the fear and greed index was sitting at 8 out of 100. 1% futures drop. That is not the behavior of a market that is about to collapse. That is the behavior of a market with significant underlying bid support that is absorbing shock. And here's the second layer that most retail investors completely missed. Jane Street getting sued wasn't just a negative headline. It was the removal of a major structural seller from the market. When one of the largest sell-side participants in any market is suddenly sidelined by legal action, the immediate effect on price is counterintuitive to most retail investors, because they only see the bad headline. What the structure sees is reduced sell pressure. And reduced sell pressure in a market with strong underlying bid support means one thing: prices go up. So you had a war breaking out, sell pressure from fear. You had Jane Street sidelined, reduced structural sell pressure. You had futures showing only 1% weakness, strong underlying bid. And you had a fear and greed index at extreme fear, historically one of the highest probability buy signals in this entire asset class. Every single structural signal was pointing in the same direction, and retail was calling Black Monday. This is the gap between reading headlines and reading structure, and understanding that gap is worth more than any price target anyone will ever give you. Let me give you the specific numbers, because the math here is important, and I want you to understand exactly what it was showing. Bitcoin was holding support at $65,600 on the weekly. That level wicked down to in October 2024, right before the last major rally. A higher low off the two prior lows, that is textbook bullish structure. Not a guaranteed outcome, but a statistically meaningful pattern that the market has respected multiple times. The total crypto market cap was sitting right around $2.4 trillion, the key resistance level from February. Fear and greed on Bitcoin specifically went from 8 last week to 10 on Sunday to 14 on Monday. A 75% increase in the fear and greed reading in 48 hours. That is not random noise. That is a measurable shift in market sentiment that has historically preceded significant upside moves. And then there is the macro layer that most crypto investors do not follow closely enough, the money market funds. Right now, there is approximately $7 trillion sitting in money market funds. $7 trillion earning modest yields, waiting for a risk-on signal to rotate. When bond markets stabilize, when the dollar cools, when yields stop climbing, that $7 trillion does not stay in money markets. It rotates. It rotates into equities, into commodities, and increasingly into digital assets. The S&P 500 opened near 6,800, absorbed the geopolitical shock, and closed green on the day. Bitcoin pushed above $70,000 for the first time since mid-February. The market structure that was building quietly over the prior weeks, higher lows, held support, compressed volatility, decompressed exactly the way the structure suggested it would. And here's the number that matters most for what comes next. Bitcoin needs a daily close above $70,600 to take out the prior swing high and confirm a continuation toward the $75,600 to $79,400 demand channel on the higher time frame. That is not a guess. That is where the structure points when you remove the noise and look at what the chart is actually showing. The math is not complicated. The structure was never broken. The crowd just couldn't see it through the fear. Now let me connect this directly to XRP and what the institutional picture looks like right now. Because the macro context we just broke down does not exist in isolation from what Ripple and the XRP ecosystem are building. Here is what I want you to understand about the relationship between macro stability and XRP specifically. XRP is not Bitcoin. Bitcoin benefits from fear, from the narrative of it being digital gold, a hedge against instability. XRP benefits from the opposite. XRP's utility, its actual functional use case as a bridge currency for institutional cross-border settlement, requires a stable, functioning global financial system where banks and financial institutions are willing to invest in new payment infrastructure. When macro fear spikes, when wars break out, when markets go into extreme fear, institutional technology adoption decisions slow down. Legal teams get conservative. Budget cycles get paused. The partnerships Ripple is building with global banks and financial institutions require a risk-on environment to accelerate. So when the macro stabilizes, when we get the kind of structural strength we saw this week, that is directly bullish for the pace of XRP adoption. And the institutional picture right now has never been stronger. We have Ripple holding a conditional U.S. bank charter. We have BNY Mellon, $55 trillion in assets under custody, serving as the primary custodian for RLUSD reserves. We have DXC's Hogan core banking platform, serving $5 trillion in US dollar deposits across 6 of the 10 largest US banks, with Ripple's full payment and tokenization stack now integrated by default. We have Franklin Templeton, $1.7 trillion in assets under management, as a named capital partner in Ripple's XRPL funding model. Ask yourself the brutal question institutional risk desks ask. Does BNY Mellon, the world's largest custodian, integrate with infrastructure it does not trust? Does Franklin Templeton commit capital to a ledger it considers experimental? Does a bank charter get conditionally approved for a company operating in a legally ambiguous space? The answer to all three is no. They don't gamble. They position. And they have been positioning quietly, structurally, in ways that most retail investors who are focused on the daily candle have completely missed. Let me tell you exactly what the next 60 to 90 days look like and why the timing of this macro stabilization matters so much. Oil is the key variable right now. Gasoline and heating oil are up over 20% on the monthly. Brent is up 14%. Crude is up 11%. That is significant. But here's the thing about oil spikes driven by geopolitical events. They are sharp and they resolve. The structural bet right now is that this gets contained within weeks, not months. And when oil stabilizes, bond markets stabilize. When bond markets stabilize, yields cool. When yields cool, the dollar softens. And when the dollar softens, that $7 trillion sitting in money market funds starts looking for somewhere better to be. That rotation, from money markets into risk assets, is the macro tailwind that XRP needs to run. It is not the only catalyst, but it is the liquidity mechanism that turns institutional positioning into institutional price action. On the regulatory side, The Digital Asset Clarity Act is in active Senate negotiation. The Genius Act, the stablecoin framework, is already law. The XRP spot ETF application is in process. Q2 2026 has the SBI yen-backed stablecoin launch, which makes XRP the live bridge between dollar, euro, and yen stablecoins simultaneously. Each of these is a scheduled catalyst. Each lands in the same window, and they are all landing into a market that, structurally, just demonstrated it is significantly stronger than the bears believed. The fuse is lit. The macro is stabilizing. The countdown is measured in months. Here is what this week's price action should make very clear to anyone who is still sitting on the sidelines, waiting for a better entry. The market just absorbed a war, a major market maker getting sued, and extreme fear on every sentiment index, and it closed the week higher than it opened. Bitcoin is now above $70,000. XRP is holding key support. The structure that was forming quietly over the prior weeks did not break. It held, and it is now beginning to expand. What that means practically is this. Every week you wait for more certainty is a week where the structure gets cleaner, the institutional positioning gets deeper, and the price at which you can accumulate moves higher. The certainty you are waiting for is exactly what will price you out of the position you want. XRP exchange reserves are near multi-year lows. The liquid float is contracting. Hidden Road and G Treasury alone represent $44 billion per day in transaction volume, now flowing through infrastructure integrated with the XRP ledger. That demand is structural. It does not disappear when there is a bad news cycle. It is baked into the architecture of the payment system. Once a financial institution commits to a payment rail, they do not switch. The tokens they hold to facilitate that infrastructure are not coming back to market at a 15% profit. They are locked for years. The window to accumulate before the circuit completes is not permanent. It closed a little bit more this week. It will close a little bit more next week. That is how this works. That is how it has always worked. I want to address something directly because I think this week brought it into very sharp focus. A lot of people in this space confuse volatility with vulnerability. They see a sharp drop. They see fear and greed at 8. They see war headlines and Black Monday predictions, and they conclude that the thesis is broken, that the bull market is over, that this is the beginning of a deep bear cycle. And I want you to think very carefully about what just happened. All of that fear, all of that panic, all of those Black Monday predictions, and the market opened green. Bitcoin pushed above $70,000. The structure held. Being early feels exactly like being wrong, right up until the moment the structure asserts itself. And what we just watched was the structure asserting itself in real time, in full view, against one of the most concentrated fear environments this cycle has produced. I am trained to distinguish between noise and signal. The noise this weekend was deafening. The signal, futures down only 1%, higher low on Bitcoin's weekly, extreme fear at historically reliable buy territory, Jane Street removed as a structural seller, $7 trillion in money market funds waiting for a rotation signal. The signal was clear. It was never ambiguous. It was only obscured by the volume of the noise. The red candles were retail capitulating. The green close was institutions holding their positions and absorbing the panic sell. That transfer of assets, from impatient hands to patient ones, happened again this week. And it will happen again the next time there is a geopolitical event, and the time after that. The question is not whether you understand the pattern intellectually. The question is whether you are positioned correctly when it plays out. Here is the thesis, stated simply. The market just failed to break down in the face of everything the bears needed it to break down. War, legal action against a major market maker, extreme fear, and it closed higher. That is not coincidence. That is structure. That is institutional bid support that does not flinch at geopolitical headlines because it is positioned for a 3 to 5 year infrastructure adoption cycle, not a weekly news cycle. Bitcoin needs $70,600 on a daily close to confirm the next leg. XRP needs to hold $1.34 and break the compression it has been building. The macro needs oil to stabilize and yields to cool. All three of those things are in motion right now. Price is a distraction. Structure is the reality. The crowd reads headlines. The informed read structure. In a market fueled by emotion and noise, We thrive on data and composure. History does not reward the loudest voice in the room. It rewards the one who was paying attention when the room was panicking. Stay patient, stay rational. We don't wait for the future, we plan for it. Drop structure in the comments if you made it to the end. I want to know who is actually reading the market, not reacting to it. I'll see you in the next one.